Okay. And I'm pretty sure mathematically it would work out if you took the 350 and divided it by the 380. Let's see, I'll play around and see how well my math chops are this morning. That would be 0.92105. And if you multiply that by the 210, and you'd end up with the same thing. If you took that and you multiplied it by the 210,000, you'd also end up with 193,421. Our son left here last night. He had an emergency in Florida. He came up here to stay. His girlfriend and her mom had an emergency and they needed him to come down, so he left last night, so didn't sleep so well. Kids are fun. You guys should have like 1,000,000 of them. All right, so any questions on the first one?
What's with the 170,000?
That was just what they would have paid if they bought the land separately.
Oh, okay.
So it says it would have paid 170,000 for the land and 210,000 for the building if they had been purchased separately. They bought them together, they got a discount. But fair market value suggests when you get a discount that you have to apply it evenly to both items.
Oh, okay. I see. Thank you.
All right. So now we've got purchased land and 2 factories at a total of 800,000. And then you have the appraised values. And you can see that the appraised values total up to $1 million. And so we want to know at what value are you going to record them. Now this one's fairly easy, and that's kind of why I like the one-step way rather than trying to figure it out. Now normally they would have you take this and divide it by 1 million. Ooh, my comma doesn't want to work this morning. Hey, something in common with me. I mean, no, love this stuff. You guys can laugh at that. And then multiply it back out again. But if you just take the 1 million and you divide it by the 800,000, you end up with 80%. And so you can just multiply the 80% times the 100,000 to get 80,000. And then the 80% times 300,000. Here, let me draw that out. Then your 80% times 300,000. And that's 240,000. And then 80% times 600,000. What's that? 480? Did I do that right? I gotta use my calculator.
It's 480.
Okay. So now we got 480 plus 240 plus 80, and that equals our 800,000 purchase price. So that's the way I'd recommend.
Isn't that $1 million though? Like the 600,000 plus the 400,000?
So that's what their appraised values were.
Oh,
Their appraised values were $1 million, right?
oh, okay.
But we paid only 80% of that.
Okay.
And so it doesn't typically happen this way, but occasionally you'll get a discount on things. Usually what happens is you pay more than the appraised values, and the additional amount on the appraised values goes into what's called goodwill. Then you end up with a janitor that's really smart and he talks with a weird accent. Anybody? Bueller? Is Good Will Hunting no longer on your list of movies?
I don't think so.
Oh, man. All right. Got a new up. Getting old. All right. Okay, moving on to number 3. All right. So we already talked about depreciation of physical long-term assets. Tangible, right? And it's the recognition of the expense as the asset is used in service. And so with long-term assets, we record all necessary costs to put the asset into service, including the purchase price. What else? You guys are talkative this morning. I like it. It's mostly Addie and Dylan.
Yeah.
What else?
Installation costs.
Good. All right. Installation. And then the old shipping costs. And they'll even allow you a short period of time where it's not quite operational, where they're sort of getting it set up. And I know you could say, well, that's part of the installation, but they're training your team. So training to operate and set up. those are all costs that to get the machine running, to get it operational, that go into the cost of the machine. And then we have a couple of depreciation methods. And we have the one that we're familiar with would be straight line. Then we have double declining balance. And units of service. And there are a couple other methods that can be used as well, but we're going to stick to those three, and we're not going to have to worry about mid-year convention or mid-month convention. When you get into, I'm just going to make a little note here. Tax depreciation is called MACRS, M-A-C-R-S, modified cost recovery, modified accelerated. Cost recovery system, and that not used for this course, but if you're an accounting or if you get into finance, the government's thoughts are they want to get cash back into your hands as quickly as possible. And as a result, they allow you to expedite the depreciation. And so just on another note, the differences in book depreciation and tax depreciation are what create the bulk of deferred tax liabilities. Just in case you see this. On a balance sheet.
Is it called MACRS, like M-A-C-R-S?
Yep.
Okay.
Yep.
Oh, okay.
And that's how it would be recorded on the balance sheet as MACRS depreciation.
No, you would not use it for financial reporting.
Okay.
Tax depreciation is separate, and you can tell typically that a company invests quite a bit in property, plant, and equipment when you see deferred tax liabilities, because that means that their creation of assets is large enough to create a difference in their depreciation. So with MACRS, usually for financial purposes, you want to have depreciation as low as possible. And so a company will say, I have 50 years on this building. And so on straight line, let's just say for an example, each year it's only $50,000. For tax purposes though, tax purposes say all buildings are 27 and a half years. And so that alone would push it up to $100,000. But the modified accelerated system also weights it on the front end. So instead of the typical whatever we're doing 5% being doubled, it essentially pushes up and gives you another 10%. And so they have a scale. If you type in MACRS into your computer, there's a scale and it tells you what asset class and what you have to take. and there's a few more rules to it. But when you use makers, which you have to for tax purposes, it will create differences between financial. So the three that we will need to know are going to be these three. All right. And we've already done straight line, so I pulled most of the straight line examples out of here. But if you need a refresher, if anybody here needs a formula for straight line, let me know. If you want, you can type it in the chat if you don't remember the straight line formula. I'll give you a second.
What is the straight line formula?
Okay. All right. No, it's okay. I'm glad you asked. So, straight line equals the historical cost minus the salvage value, all divided by the expected years of service. Okay.
Thank you.
I haven't used the double declining balance when I have to look at it when I type it out. I believe the double declining balance is equal to 2 times the straight line depreciation rate percentage times the book value. And then the units used, you essentially come up with a base price so you have units of service, and you come up with a cost per unit, and the cost per unit is basically the total cost divided by the total units, and then you multiply the unit cost by the actual use. Okay, so those are the 3 formulas that you're going to be responsible for. And so let's take a look. Oh, one other reminder here. Remember, book value equals historical cost minus the accumulated depreciation.
When you say on the units of service, it's unit cost times use. The use is the amount of years that it's used.
No, so typically with units of service, like a car. So if you think about a car, when you talk about units of service, what kind of units of service would you use?
Miles.
Mm-hmm. So if you expect in the early part of the car's life, you're going to drive it a lot. You would want that depreciation to match up with that vehicle. And so let's say you think it'll go 300,000 miles. So you'd put it in there, your historical cost, divide it by your 300,000 miles, and you'd get a cost per mile. And so each year you would track and say, how many miles did I drive it for work? And you would multiply that out times the mileage. I know I've got an example in here, so we'll take a look at that. Good question. Good question. You guys are awake for Monday. I could do this all the time. You guys are better on. What's that?
I said, not really.
Yeah, you guys do better online when I can't see you. I need to come up with those face masks in class. That's what we should do the first day. Although there's probably somebody in the room that'll scare me. The Freddy mask. I'll be like, oh. Do you guys remember Freddy from Friday the 13th?
Krueger?
Yeah. All right, you're one. So
I know the name.
I got to work on my references. I haven't seen a movie in like decades. All right. So company owns an asset with a historical cost of $75,000, an estimated useful life of 10 years, and a salvage value of $5,000. As of December 31st, the asset had accumulated depreciation of $49,000 after the adjustment. Company still owes $20,000 in liabilities from the purchase of the asset years ago. What's the asset's book value? So first, we really want to get rid of the extraneous information. And this is really extraneous information because we don't care what they owe on it to come up with the book value. So book value equals historical cost minus the accumulated depreciation. In this case, 75,000 minus the 49,000. And the reason it says after adjustment is typically if you're going to sell it, you have to make the adjustment. So if there's kind of a mid-range depreciation or you haven't yet made the year-end adjustments, you want to make that before you try to figure out the book value. And so I think that's what, 26,000? Okay. Now, this 20,000 here that I crossed off, what might that help you find?
Can you give us a hint?
I'm sorry, say that again?
I said, can you give us a hint?
Well, some of the questions ask about cash. And when we talk about depreciation is, and I don't know if I've emphasized this enough with you guys, but if you guys know it, I'll be really happy. So if you're trying to figure out some things about this, you'd want to know how it affects the balance statement, or the balance sheet, excuse me, right? How it affects the income statement. And then what's our third statement?
Cash flows.
Cash flows, good. So that 20,000 might have an effect on our cash flows. So remember, I'm going to get it up here. And I want to make this really important. Remember, depreciation is never cash, right? And that's important because, I was giving you guys my phone number. All right. It's never cash. It's an accounting construct, and it's a way to expense the asset over the useful life of it. But cash is something that you're either going to pay out at the beginning or you're going to pay out at over time. And so in this case, there's some payout over time. All right. So when they're asking in this chapter, it'll ask about cash flows. You want to remember depreciation is not a cash flow. My daughter just said thanks for her birthday message in the morning. 17 years of love. I got one text from her this week and it said, buy me this. And it was a Pandora bracelet.
Did you buy it?
Yeah, I did. Daddy's little girl gets what she wants. Our older daughter she was struggling with a beater car at college. And so we bought her a car, but she's graduated now. So we've got a little bit more money. Okay. So let's take a look at this one. They're going to use the units of production method. The cost is $24,000. It's estimated to have $2,000 useful life and 200,000 miles. How much expense would be reported on the income statement in which the truck has driven 50,000 miles? So why don't you guys give that one a shot? Don't forget to take out the salvage value as well.
I thought it was the total cost though.
Yeah, it should be the net. I'll get my calculator to work this morning. That's good news. I was checking Pearson while you guys were doing that question. And it looks like Pearson's all up and ready to go. Ooh, did I speak too soon? No, looks like it's ready to go. Okay, so did we come up with some answers? Let's see some in the chat. What we got? You can just type it to me if you don't want to be brave. Got two correct. All right, looks good. You guys are awesome. All right. Everybody pretty much got B on that one. So we have 24,000.
You said B or C?
C, I'm sorry. 24,000. I did say B, I apologize, but I meant C. Minus 2,000. And then we're going to divide that by 200,000. And then we're going to multiply it by 50,000. And it ends up being 5,500. So good job there.
Professor, I did mine a little. Is it okay if you divide the 50,000 cost like per mile, and then do that times the salvage value, which would be the 22,000 times 0.25?
So you had a little bit of lag in there. So did you essentially do a quarter, 50,000 divided by?
Yeah, I did 50,000
Divided by the 200,000?
divided by, yes.
Okay. So yeah, that would work as well. My computer was a little wonky here. What did you guys get for per mile?
11 cents.
Okay. All right. The other thing, and sometimes you'll see this as a percentage, but essentially 50,000 divided by 200,000 equals 25%. So if you multiply that times the 24,000 minus 2,000, it will give you the same thing. All right, so there's going to be times where they say, what's the percentage? There'll be times where they ask you for the dollars. So it's good that you can kind of know it both ways, but keep in mind, math, it's kind of like anybody of you live in Massachusetts?
Nah.
Do I have any brave souls that'll admit that they live in Massachusetts? All right, let's go on a wild goose chase here because we only got 4 minutes. I'm going to share a different screen with you. All right, you guys can see my whole screen now.
Yep.
Okay. Actually. You'll have to forgive the foreign language here. So you see how New York City is nice and organized?
Yeah.
Pretty much squares.
Oh, yeah.
Want to take a left, want to take a right, you pretty much know where you're going. And then da, 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 da. Boston. If you can find a square in there, good luck.
It says a naughty word.
Yeah, you didn't see the naughty word.
That's because New York's the best.
Well, I have to say with their streets, I would completely agree. We've decided that we were just going to follow cows around and put bricks around it. But as you can see, I'm a Red Sox fan.
Go Sox.
Boo.
Hopefully we'll even get a baseball season in this year. So I've used up class. Hopefully we've had a little fun today and not too much pain in the learning department. And we'll pick up on question number 5 next time around. Does that work for everybody?
Yep.
All right, I'm going to jump into Pearson after I get off the call with you guys, and I'll straighten out the dates for you. If you have any questions, you want to talk to me, I'll be here for office hours and via email. I really appreciate you guys hanging in there. I'm trying to work some things out, throw some extra credit out there for you. If you have any issues or problems, please call me. I know this isn't easy. Call, email, text. Like I said, you don't have to tell me anything personal that's going on in your life. Just, we'll work through it. We'll figure it out.
Thank you, Professor.
Take care. Have a good day.
Thanks, Professor.
Thanks, Professor.
Professor.
Professor,
Yes.
when are your office hours again?
So I have office hours right after class. Usually I'll take like a 10-minute break and I'll come back about 5 after 10. And then I'm usually here until 5 minutes before my next class. So I'm usually here 10:05 to 11:55. And then I have class from noon to 1. So if for some reason you guys miss the information, or if you just get up late and you want to come to the noon class, you guys are welcome to do that. And Then I have office hours from 1:15 to 1:45. Usually I will extend them to 2 o'clock, but on Mondays I have to take a break because I have like a 3-hour class on Mondays starting at 2 o'clock.
Oh, okay.
All right, but I also am available on Tuesdays. I try to set up the private ones on Tuesdays. There's a few people asking for questions about their grades, and unfortunately, we've got 2 tests in now, which is about 20% of your grade, and some homework and quizzes. But the quizzes are extra credits, so they're going to add to your exam scores. So I have to come up with a template, and I want to just get it out there to everybody. And so I'm working on that. I will have that for you guys for Wednesday's class so you can calculate your own grades.
Okay. And when are we having the reading? When's that reading quiz due again?
I will set it up for Wednesday, but I'll try to make it, if I can get it all done today, I'll basically set it up that you can do it anytime you have 12 minutes between now and Wednesday night. But I
Okay.
know the book was down a lot longer than they expected, and so I don't want to hold you guys to not having the opportunity to read it. I know I myself, if I have a weekend, I would have nuzzled up with the book at the end of the weekend. I wouldn't have read it early, and unfortunately you couldn't do that yesterday. They said it was supposed to be done at 9 o'clock, and I'm not sure whether it was Eastern or Central, but either way it ran much longer than what it said it was supposed to.
Okay. Okay,
All right.
thanks.
You're welcome.
Thank you, Professor.
You're welcome, ma'am. Do you have any questions, Tyler, or did you fall asleep at the wheel? All right, bud. I'm going to end the recording.